Hi, I'm Jim Cunningham. I've got John Barrentine here with me. Today, we're going to talk about the Los Angeles real estate market. Get in or get out. I guess the other one is perhaps stay in the real estate market. Disclaimer is very important. I'm a lawyer. My lips are moving. John's going to be talking. He's a realtor. It's not legal advice, folks. Don't watch this and be like, well, John said and Jim said, and I'm going to go out and do a bunch of stuff. That's kind of like running with scissors. All right. Subscribe to our YouTube channel if you're watching this on YouTube. It's a great way to stay up to date on all things taxes, estate planning, real estate investments. I'm the managing partner of Cunningham Legal. I'm a certified specialist in estate planning, trust, and probate law. 25 years trust and estates experience, and we have offices in the San Francisco Bay region, Southern California, and Capital region, which is Sacramento. I'm securities and insurance licensed and a licensed real estate broker. I don't sell any of that stuff. I guess I'm just a lifelong learner. And John is based in LA, and John Barrentine has 26 years real estate experience, and he's the founder of the Barrentine Group. He's the director of the California Association of Realtors. It's kind of a big deal, right? And director with the professional standards arm of the Beverly Hills Greater Los Angeles Board of Realtors. So I want to welcome you, John, here today. I'm super excited to talk about LA real estate. I love real estate. LA to me, I lived there. It's where my wife and I first started living in the Miracle Mile area when we got married in 1992. And, it's just a great city, great place to live. But tell me, let's talk about LA housing. Is there plenty of housing in LA? Or
Absolutely. Well, I wish I'd known you when you were here. We would have been neighbors. We were just a few blocks apart without knowing each other. I think the only way to begin a reasonable conversation regarding real estate in Los Angeles is to talk about the housing shortage that we're experiencing. It is significant, and we know it's statewide, but we find it really acute in the Los Angeles area. So what we know is that based on the Myers Park Mendoza report that you see on the screen in front of you, we would have had to have completed another 544 units per year from 2016 through 2025. That has not been happening, and that number has actually now been revised to, we should be building 700,000 units per year in total, right? To get us where we need to be by 2025.
Hold on. So, I'm sorry. I did these slides. I thought it was 544,000 units for 2016 through 2025. Are you saying it's 544,000 a year?
No. Cumulatively, total. Yeah.
Okay. All right. I was going to say that's
2025, and in fact, that number has actually been revised. As you take more into consideration, we are really short of 700,000 units between 2016 and 2025. And the thing that got my attention a few years ago was a quote by the Los Angeles Times, which said that we would need to have created over 1 million more housing units in Los Angeles than we have created today to simply have the average appreciation that we see in most of the country, which floats out to be around 2 to 3% per year. But as a result of that shortage, the appreciation that we're seeing in the Los Angeles market has been astronomical and something that I haven't seen in my career.
Amazing.
The past year and a half. Incredible. Incredible.
And we're not just talking the super high end. It's
everything.
It's everything. It's not like these aren't just houses in Bel Air or Brentwood or wherever.
No. The entry level market, of course, people are still struggling to get into the market as quickly as possible with rates where they are. Affordability is at a low. We've seen 17 historic rate lows over the last 18 months. So there's no question rates are really driving the market on the demand side.
So this is really, this is a supply and demand issue, right?
Completely. It is strictly economics of supply and demand in Los Angeles.
And then during COVID, how many people left LA? I think when we were preparing for this, wasn't it about 1 million people or something?
Yeah, I have not seen that. I have not seen that stat in that way. What we know is that we've seen a lot of people buy secondary homes. We've seen, so there are probably fewer people around town during COVID as people stepped out to their ranch in Montana or to their place at Big Bear, or they went to the desert because it was a little quieter. So secondary homes, huge explosion in that market at the same time. What we do know is that, we're a tale of two economies, as we are really all across the country. The people on the upper end of the economic scale, gained incredible wealth over the last 18 months during COVID. The service sector, the lower end of the job market, really got hit, and a lot of those guys stepped out of income properties, out of rentals and apartments, and went back to their parents in Iowa because they could work there and live for free. Why should they pay $3,000, $4,000 a month for an apartment that wasn't doing anything for them in Los Angeles at the time? So there's been a real dichotomy in what's been happening in the city in that way.
Well, LA is a big place.
It's a massive place. And just to put it into perspective, because we're going to be talking originally or initially today about countywide statistics, LA County is, were we to be a state, we'd be the 10th most populous state in the United States, to put it into perspective, right? For those of you that know LA, we'd be, I think it would push North Carolina to number 11. We've got more people in the city of Los Angeles or county of Los Angeles than in North Carolina. And we're larger, of course, than Rhode Island and Delaware combined. So as we look at stats and we start looking at the mass that is Los Angeles, it begins to put some things into perspective. So we're going to look at it that way, and then we're going to drill down a little later on some specific neighborhoods.
Okay. So we're going to cover some specific places in LA. That's really fantastic. So
absolutely.
In getting ready for this, I just see a progression. There is a declining number of homes put up for sale every year. It's just going down.
Absolutely. And as discussed, as we began with the housing shortage, this is what we're seeing. And so, of course, COVID has also made it's impossible to talk about the current market without talking about the COVID overlay of the market and how that's affected us in subtle and in some ways not so subtle ways. And so what we're seeing and on the graph in front of you, you'll see that we had more supply and demand, of course, the orange lines as we see 2018, 2019. So more supply there. 2020, backed off a little bit. 2021, even less supply. And in a moment, we'll be talking about demand and how great demand has been. So this is just indicative of the issue that we see in front of us. What it's created in our market and is really about 2 months of inventory, meaning that if no more properties came to market and we continued at the pace that we're at now, within 2 months, we would have no inventory. There would be no homes left to sell in the city of Los Angeles. A balanced market is somewhere between 5 to 6 months of inventory. So we've been in a seller's market for an extended period of time. What we have seen is that COVID has made that seller's market not just hot, but white hot.
I had a wealthy, in doing the trust and estate work, I encounter a lot of wealthy, older, wise people. And
yes,
one of my clients said, you never get a deal on real estate. It always trades at its market price. It's what you do with it after. And I think there's a huge element of truth in that. And I'm looking at this low number of houses available. It just must be making buying a home. And this is more on like the buying the home side. It's such an emotional purchase. It's got to be a roller coaster for these people. I mean, is it multiple offers coming in? What's that looking like?
Yes. So we've been in a multiple offer scenario for really, as we've been in a seller's market, that creates multiple offers. We've been in that scenario for 8-9 years now, almost a decade. So buyers are accustomed to that, and agents are accustomed to that. Seasoned agents are accustomed to that. What we've seen over the last year and a half, and so we had a decent first quarter in 2020. We had a plunge in the second quarter of 2020 as shutdowns happened. The market rebounded in July of 2020 in an amazing way. And since then, we've seen just this incredible demand for property, and which has pushed a property that you would have had 3 or 4 offers on to 13 or 14 offers, right? So buyers are exhausted, frankly. Buyers are discouraged. The buyer that isn't resilient often steps aside and says, we'll just wait for things to get better. I don't know what that means to them. And we have those conversations and we drill down on that, because the only thing to wait for are for rates to go up. And if rates move up, you've lost in the big picture, right? I mean, if it doesn't feel good to be competing at a really high level now, and if we believe there's a surge in pricing, which certainly there is, it is still more affordable in the moment to buy at current interest rates than it will be if rates move up a full point. And that's the only thing in the cards right now that's going to slow this market down.
Oh, how about rents? Are rents going up? Are they solid? Is there weakness in rents? I know there was during COVID. My son rented a place in Koreatown and got a really good deal on an 8-month lease, but it was only an 8-month lease, right?
We saw huge softness in rents during COVID. That market rebounded in probably the fourth quarter of last year from the income properties that we had for clients, that we were doing some leasing for them in the market, things that we couldn't get any activity on in June, July. We're leasing very quickly by October. So that market has rebounded. I wouldn't say that it has fully recovered, but we've absolutely seen some normality return to the income family, to the rental market. Absolutely. So,
and we had a question here. Somebody said, please discuss the San Diego metro area where we don't have a webinar. This is one of 3 today. We just didn't cover San Diego, but also the commercial properties. And thank you, Gerald, for that. On the commercial, are you seeing strength in the industrial market, storage facilities, and weakness in retail and office? Tell me a little bit what's going on there.
Well, what I will tell you is I'm not a commercial guy. What I'm prepared to speak with you about today is the single family, condominium, and multifamily residential income market, because that's our segment of the market. We do what we do and we stay in our lane, and we really focus, and we've got our hands full with that. I've got amazing commercial guys here that are in my office that I'm happy to make any connection to for people that have those commercial questions. I'm not familiar with it, and I can't speak to the commercial market for you today.
Well, let's talk about
in all honesty, that's not my field.
No, it's fine. Yeah. Let's talk about pending sales, single family and condos.
So we were talking about the supply side, for a moment ago, and here's demand, right? And so we saw that low supply line. Here's the demand side. And so the green line is 2020. So as we were saying a moment ago, we had a really heady first quarter last year. Things were off and running for the year in a great way. As the shutdown came toward the end of March, you'll see that's where that huge dip is. And then May, and then by June, we were sort of coming out of that. And so that green line would have been much more, much flatter, because the spring market really got pushed to the fall. I mean, that's the long and short of it is the heady market that we typically have in the spring and that we were on a trajectory for got pushed to July, August, September. So that's unusual for us. So we see the move up, as you'll see in 18, 19, 20, and again now in 2021, we typically see a nice move up in the spring market, and then the market plateaus and just sort of levels off for the rest of the year, and it is what it is, and it's solid and strong. So, but what we've seen this year is that red line from 2021 is above and beyond what we've seen over the last several years.
Wow. And
that demand line combined with that very low supply line has given us the double-digit appreciation that we saw in the spring. And it has been, again, we had a run up in 2004, 2005, as we all know, prior to the Great Recession. We were feeling it then. We were feeling the double-digit appreciation in that way. This year, it happened so quickly and in such a short time frame, we begin to use the term surge in pricing. And as in, if we're looking at comparable sales, did it happen before or after the surge in pricing? And that surge came between April and June. And we were clamoring to stay on top of value, right? And this is all we do all day, and we're in it. We're in touch with all of it, and yet we were to the point like, where are we in the market, and what's happening? And wow, can you believe that just closed at that number? And it was astonishing, to see what was happening in values in my neighborhood, that we do a lot of work in, and seeing that exponential jump in pricing and in closed sales. And it has been amazing. It's been amazing. So for anyone that has been sitting on property for any amount of time, you may have heard that the market was strong. You may be surprised to find out, exactly where value is for you today. And we're happy to have those conversations and really get you apprised of very specifically micro market by micro market where you are today with your property.
Yeah, Gerald asks in the chat here, he says, do you think that the COVID restrictions led to a reduced demand for office space? Yeah, we just did another webinar in the Bay Area,
Yes.
and that subleases spiked. It's kind of the repurposing of office space is the next wave. So in whatever that looks like. But Gerald also asks, do you think the COVID restrictions led to an increased demand for larger single family residences?
No question.
Which offer work from home. And then what's the underlying cause for these increases? I mean, obviously it's demand, but I wonder, John, is this people in LA looking to move up, or are these people coming in from like Chicago and they said, I'm tired of winters, I want to move to LA? Do you know what I mean?
Interesting. Yes. And that's a great question. And we saw that happen in a number of ways. So some of the migration that we did see moving out of Los Angeles was LA moving to Central Coast, right? Or LA moving to a smaller market, Austin. So the LA Austin market, we've sent a lot of people to Texas this year. LA to South Florida in suburban areas, we've seen that this year. LA to Boise, we've seen that this year. So our metro market moving to those smaller, those feeder markets has absolutely taken place. The other thing that's taken place are people coming from major metropolitan areas, New York and Chicago, and are coming to Los Angeles for lifestyle, for climate, for a city, but with a more suburban feel, stepping out of that compact urban downtown environment that they were in, and wanting to be in a single family home with their own private yard, being able to create a safer environment for themselves. So that has worked both ways this year.
Yeah,
my clients right now coming from New York that can't wait to get out of New York.
Well, I mean, that's what I was going to say. You just don't get that in New York City. If you're in Manhattan, it's not going to happen. And I mean, there's a lot. LA's got its challenges, and I've lived in LA a few times over the years. It has its challenges, but it's also got a lot of great things going for it. So question is, are there plans to build more housing to meet the 700,000 unit housing demand?
Yeah, that's the big question. So there are some interesting things going on in Los Angeles right now in the way of development of new housing. One of them is the new ADU law that is statewide. So we are seeing, because we have in the inner neighborhoods, they're very old neighborhoods, most of them between 75 and 100 years old in the housing stock. And predominantly single family and zoned as such. We can now, and I am in the process personally of building an ADU for my mother-in-law eventually in our backyard, and then then for whatever our purpose will be in following. But ADUs, there were, I don't have the stat in front of me, but something to the effect of 2 years ago, there were 7,000 applications for ADUs. This year, there were 35,000.
Oh, wow.
Yeah, good. So it is exponentially, again, a way that we're creating additional housing in Los Angeles. The other way that Los Angeles has been creating additional housing is through a transit-oriented corridor program. So you'll hear it called TOC. And so TOC affects a certain distance within designated transit-oriented corridors where developers may pick up properties to build multifamily homes, and they get a significant density bonus because they are within walking distance of a transit-oriented corridor. So all up and down Wilshire, San Vicente, Beverly Boulevard, Sepulveda, any of the major thoroughfares, we're seeing housing being built right and left. The majority of it is being built for rental. We're seeing some condominium construction that will probably come out as rental property and then eventually be converted, but they're being built as though they will be condominiums. The condo market has been a little bit softer for us, along with COVID. People have been looking for, again, privacy, seclusion. Communal housing has suffered just a little bit. I wouldn't say that the condo market is soft, but we don't see the clamor and the multiple offer situation in the condominium market right now that we're seeing in the single family market, certainly. Yeah,
and we did another one of these about a few months ago, 10 months ago, something like that. And it was a similar thing in San Francisco. It's not that the condo market's soft, it's just that people want the more space. They want control of their environment.
Correct. People want to be able to control their environment. And if they don't feel safe and that they can do that In their condominium, they've moved to a house more suburban on a single family lot. If they were in that single family home and they still felt like they were surrounded by too many people, they've stepped out of Los Angeles and they've gone to Los Osos, right? I mean, so it's been really interesting.
Charles asks, and Charles is a client, and I know why he's asking this, but Charles asks, I see a fall off. Essentially, I see a fall off in the fourth quarter. What is that? Does that mean demand's going down? I have an answer. I think I have an answer, but I want to hear your answer first.
Well, we're not incredibly seasonal in Los Angeles,
Yeah.
but that's what you do see is seasonality. I think people get distracted toward the end of the year. Not that things don't sell regularly. December, January. December is the slowest month of the year, followed by January being second. And typically, although you're not going to see it on these charts in front of you, the last 4 years have been strong for us, but typically summer. So between the 4th of July and Labor Day, when we were very entertainment industry oriented, more so than we are today, the whole industry would go on hiatus and everybody checked out and vacation, and people got lost a bit in the summer as well. So we're not incredibly seasonal, but you will see that little taper off toward the end of the year, but it doesn't mean that you can't sell a house at a really great price. We just like to, if we have the opportunity, we like to be strategic about it and make sure there's many eyes on the prize as possible, when a property is launched.
Well, I think the reason for this has to do a little bit with the psychology of a mattress store. If you're going to buy a new mattress, you go to an intersection and you look around and you're like, there are 5 mattress stores here. Why are there 5 mattress stores? Why wouldn't you put a mattress store someplace else? Because that's where people go in that area to buy a mattress. They go to that particular intersection. That being said, I think the decline in sales, probably if you looked at the listings, you would have a decline in listings. So Charles, it's not so much that there's an even amount of listings. It's just that the sellers also get distracted because you've got the Jewish holidays in September, you've got Thanksgiving, you've got Christmas, and you got Chinese New Year right after that. So you have all these holidays kind of mashed up and people get distracted. So it's a lack of listings is more.
You're absolutely right. If you flip back one slide, you'll see exactly that. So that line, exactly, there it is. That's exactly what you just described, Jim. Yeah. So people are just not in the mood to put their houses on the holiday, on the market during the holiday when they're entertaining families coming. They're doing, they're doing their thing. The way it works out is that, of course, while there may be a little bit fewer, there are fewer people looking, there are also fewer properties that are on the market.
Right.
So that still gives us that solid line of buyers and sellers that are there, right? That are matched up in that way. So it's the holidays are not a bad time. Although I would say if I were directing a buyer, the holidays are when you get the best pricing of the year. So if I were your buyer, you'd be on the market, but you'd be looking between November and February, right? That's the greatest time of year to buy. That's when prices are at their softest.
So what is the MLS? What is that?
So the multiple listing service is the way in the residential world that we're all connected to other brokers. And so the multiple listing service, this is just a chart because we're going to step into talking about some multifamily properties here. And it's easy to talk about the broad stroke of properties in the single family condo world. When we start talking about multifamily, we really want to drill down and be a little more specific. So I thought what might be interesting would be to choose, I think there are 5 areas that are here sort of spread across west to east across the continuum of Los Angeles. And we could begin to drill down and look at a few of those. So
wait a minute, is 33 here? Is that oceanfront property? Is that all that
33 is Malibu Beach, and that's a very thin strip, and it's hard to see on that map, but that's Malibu Beach side versus Malibu Hillside. And it's radical, right? It's a radical difference between those two. Yeah, and so and just another word on that, so we are not limited to the MLS area, so we are reciprocal through the entire southern part of the state of California. The San Fernando Valley would be just to the north of this, the South Bay, to the south of us, and then Glendale, Pasadena. They all have separate listing services. We're all in the same. Just for this purpose, it was easy to pull information this way.
All right, so West LA.
Yeah, so the first is absolutely West LA, which kind of straddles the 10 and the 405 right there. Heavily laden with multifamily properties. Not a lot of single family stuff in the mix there. This particular area has seen tremendous growth. We don't see an incredible amount of activity coming on the market in the area. We do see probably 20% of those properties move every year. So the West LA market is, the rule of thumb being, the closer you are to the beach, and this West LA market abuts Brentwood and Santa Monica. And so what you're banking on in West LA is probably more appreciation than cash flow, unless you've been sitting on those properties for a very long time. Anyone that's stepping into that market immediately is really talking about land banking, essentially, is finding a safe place to park your money where it's going to appreciate for you nicely on a monthly basis. If you're stepping into this market and you're picking up an income property in that 2 to 4 unit range, probably not penciling out on a monthly basis in cash flow. In the small commercial multifamily market, in that 5 to 20 unit market, you're probably seeing, you can begin to see some cash flow once you get to that volume.
What kind of cap rates are you seeing on those, the 5 to 20?
Yeah, 5 is golden in LA. Tough to see much of a cap rate above that.
Yeah.
Of course, your cap rates will vary again as you move across the continuum of the city. Cap rates toward the beach, again, because you're seeing more appreciation, you're seeing a little less on the cap rate side. Right. So people will squeeze into a quality building in the 4s, honestly. Okay. Everyone would love to see 5. I mean, we've seen.
No, I meant 5 units to 20 units is all. What are you seeing cap rates at, like 3.5, 4.5, something like that?
Yes. Okay. In this location, yes. Right. 3.5, 4.5, and people are picking those up. How
sensitive, so interest rates always comes up because you have all these variables. You got supply, demand, you have interest rates. That's a really big factor. There is seasonality, but seasonality is its own thing. But if there is an increase in rates, which I have no idea what's going to happen. I'm not clairvoyant, right? But if rates go up 1 or 2%, 100 or 200 basis points, do you see that really kind of putting a headwind on real estate or not?
Yeah, I think so. I think we are and have become so incredibly rate sensitive, just as a public, mm-hmm. And as consumers. The moment we move from 2.75 to 3, it kind of knocks a lot of people off the fence that have been thinking, oh, well, I can hang out, I can wait. And all of a sudden there'll be a flurry the next 2 weeks when we see a quarter of a jump, because people think, oh, okay, now's the time because it's not going to get any better. So I know we're incredibly rate sensitive in the market that we're in now. Our concern about that, quite frankly, and especially in the single family world, is that people are not going to give up those 2 3/4 rates to step out and make a discretionary buy and pick something up at 3 1/4 or 4. Right? Once we get to that point, there's going to be this lockdown effect in the market.
Are you seeing that most people are buying property cash? Are they doing finance? I mean, is there a breakdown?
Yeah, I would say the last stat that I saw on it, we're probably seeing about 15% of the deals in the marketplace all cash. And we experience that regularly. They may show cash up front and then turn around and get a loan anyway. They're writing cash deals just to win. But you get the call from the appraiser, right? Ultimately, they're taking out loans, and why not at 2.75 to 3? You can certainly leverage that money in a much greater way in the market. So yeah, absolutely. But the amount of money that is being put down makes this market real, right? I mean, these guys are walking in 20, 25, 40, 50% down. So there's a lot of cash that's floating out in the Los Angeles market. And that's what keeps us from being in the same situation they were in 04, 05, right? Yeah. Where we had funny money in the market.
Well, not only that,
it's
where you did 103% loan to value loan, and you get a check. Like what?
Close and I'll give you a bonus.
What planet is that, right?
Who thought that was a good idea? Well, a lot of people did, actually. But that's the difference in 04, 05 versus what we're seeing today, right? And I think that there's a lot of misinformation in the market. I hear, I'm not a TikTok guy, but I hear that there's a lot of information, a lot of video on TikTok talking about why it's not a good time to buy. Like, we should all be looking at TikTok to advise us on what we should be doing with our money, other than buying stock in them. So I think there's just a lot of different, a lot of disinformation that's in the market at the moment. I think we really have to pay attention to our sources and bring it back to the real conversation of rates, supply, and demand. Bottom line.
Look at this. This is an amazing figure. This is the number of income properties for sale in the entirety of West LA.
Yeah. Yeah, I think right now there are 13 as of this. So these are, so what we're looking at is year to date over the last 4 years. So this is the first 6 months of the year from 2018 to 2021. We're seeing a little less on the market right now than we have, but honestly, a little less means 5 fewer. Right. So right now there are 13 properties on the market in West LA. So it's a tight market in that way. If you go to the next slide, so that's supply, and right behind this is demand. So, we're seeing the move, but the first 6 months of the year, what we saw, 9 properties move, 8 properties move. So it's a tight market in West LA, not a tremendous amount of inventory coming along. And, and we see the effects of that. Not a lot of opportunities in that.
So if I'm going to sell a multifamily on the West Side, how does that work? Walk me through what that would look like. I call you and I say, John, it's time to sell this 10-unit apartment building. How long do those transactions take now? What work do I have to do before I list that property for sale? What are the deals looking like now than maybe say 15 or 20 years ago?
Well, I think more than ever, people are looking for value add in this marketplace. I mean, we are in a market where you can spend money and make money. Right? Mm-hmm. That's not always the conversation, of course. So if there is an asset with an upside for value add, that's a real plus in this market. I think we're finessing income properties more today than we ever have. That conversation begins with a long consultation about, first of all, goals and what's important in the sale of the property. And then there's a whole lot of information gathering. So we're talking about tenant mix, we're talking about condition of the property, we're talking about rent control and where the property is. Anything built before 1978 has rent control, newer properties not so. So there's a lot that goes into that mix and that conversation. And it's a conversation that we welcome. We love the strategy of those conversations surrounding income properties and the spreadsheets that go along with it.
Yeah, right. It's a little bit different than buying a house, right? Because that's more of an emotional.
It is. The single family market is more personal and nuanced in that way. The multifamily market is more specific in its way of we're working numbers, right? And we're looking at cap rates, bottom line. We're looking at gross rent multipliers, but ultimately we're looking at cap rates. And so it's an interesting conversation and one that can be incredibly successful for those that have been sitting on income property for any amount of time. There's no question they're in demand. And as we come out of COVID, I think that there will be even more demand for multifamily properties. There has been a lot of fear, and we lost a couple of deals last year at the beginning of the collapse because people were afraid that were in those escrows. Were those tenants going to continue to pay rent? What would that look like? What would cash flow look like? And then once we had established, right, that the bottom wasn't falling out of the market in its entirety, we were able to go back in and establish for our seller clients with those tenants, yes, they have a solid job. Yes, they haven't experienced any disruption in rent. And we were able to substantiate that, take those properties back to market and sell them again at roughly the same level that we were in pre-COVID. So, and I think as we step out of COVID and it eliminates some of those questions, for instance, eviction moratorium, like all of that's going on, that's made a lot of people nervous about the multifamily market. That market's going to solidify for us again.
Yeah. So, I mean, just anecdotally, do you find that your tenants are paying their rent by and large or not?
By and large, we do. Yeah. I have not been involved in a multifamily sale where they had people that were not paying or involved with clients that we handled some rentals for that are ongoing clients of ours. We handled some income rentals for them, and that has not been an issue at all.
So these are the pending properties, and
these are pending.
Looks like 18 was an active year for properties trading.
Yes, it was.
Yeah,
it was. From there, the next one, we go on to Culver City, which is an incredible success story in and of itself. For those of you that are familiar with Culver City has seen an incredible amount of development in the city itself. Since they renovated downtown, they've got a strong school system. There are a lot of reasons that people are looking at Culver City. And so when we step into the charts following that, we show that in that Culver City market, we saw a bit of an increase in the number of buildings that came on the market in 2021 for us there. The thing that Culver City has experienced and the sale, so this is supply, demand is right behind that. You're going to see a decrease in demand in Culver City overall, and here's why. Culver City enacted rent control this year. It became law in October of 2020. All landlords had to be registered by July 1 of 2021. So that's had a little bit of a short-term, what I believe will be a short-term chilling effect on the market in Culver City, because people are always like, oh, well, I can go to Culver City, or I can go to Burbank, or I can go to Inglewood, and I can pick up properties that are no longer rent control, or that are not covered under rent control. That has essentially gone away. Inglewood now has rent control. Culver City has rent control. And so I think that's a short-term thing that I think will adjust over time. Anytime there's change, it disrupts the market, of course. And so I think it's just a matter of time before Culver City comes back in that way. Great, strong market, incredible location, close to the airport, close to the beach, whole lot of reasons that tenants want to be in the Culver City area.
Yeah, it's
Silicon Beach. Right.
And like you were saying, they converted the Helms Bakery, that whole
Yes.
development, which is fantastic.
And the train just came through Culver City.
Yeah.
That the Gold Line that now goes to the beach has a stop and just right there downtown Culver City. And if you haven't seen it recently, it would shock you. If I don't drive through Culver City for about 3 weeks, it's hard to tell where. I mean, honest to goodness, it is going up so quickly. Yeah. And the development and the retail and the restaurants and the coffee shops and the multifamily complexes called Platform, which is right around the train station. It is unbelievable what's happening in Culver City. And as we see development or investment in the city itself, HBO moving their headquarters to Culver City, people being priced out of the Silicon Beach area further to the west and stepping back inland just a little bit, are all landing in the West LA area that we looked at a moment ago, and now into Culver City. So fascinating. Here, the mid LA market. So this stretches along the 10, just to the west of downtown. This is a market that has a really robust amount of activity. And if you look to the next slide, you will see that consistently in this area, they're floating around 200 properties for the year. So when you're looking at 19 properties in West LA, you're looking at 200 properties in mid Los Angeles. Right. So this is an area that is really ripe for development. We see people going in, picking up multifamily properties and actually flipping them because it's so hot here. And it's just a really, really, really robust market with a lot of older property stock. So there's a lot of value add in this mid LA marketplace.
And again, it's very convenient right off the 10.
That's it.
Very easy to get around. It's not taking you 20, 30 minutes to get to a freeway.
Transit corridors everywhere. Yeah. Main, east, west, north, south streets, converging all through the area. And this is sort of West Adams, you'll hear it called. So a lot of historic single family neighborhoods through there, but a lot of older housing stock. And frankly, a lot of 60s buildings, 60s, early 70s buildings that slipped into these neighborhoods that make, that are ripe for the picking. So other than soft story construction.
Are they tearing them down and they're raising the building, underground parking, maybe 2 or 3 stories, luxury type. Okay.
Yeah, paying tenants to leave those older buildings, buying them out, cash for keys, sending them on their way, developing.
And then we got sales here, similar number, fair amount of properties trading here.
A lot of trading here. So roughly about 35, 40% of things trading, really strong. So this is what's called in the MLS Park Hills, but this you will know as View Park, Baldwin Hills, Crenshaw, Lamert. The train is headed south right now through down Crenshaw, which will connect over to the airport as close as it's ever going to get on a people mover. So God bless LA and trying to get people to the airport on a train. But these markets are incredibly hot right now. The amount of investment, of financial investment that's going in, the Baldwin Hills Mall is being redeveloped, restaurants going in everywhere, again, coffee shops everywhere, multi-use buildings, so retail down, rental up. All along that train line has really blown this area up over the last couple of years. It'll be really interesting to see that train line opens within the next year and a half. So it's going to be really interesting to see the gentrification of these neighborhoods. It's tough to find a single family property in Lamert under 7 figures any longer. A lot of these properties have incredible views on the single family side, some on the multifamily side. But people are picking these up right and left and believing that that's a great investment for the future as people are accessing transit. You'll see in the next slide, supply for these neighborhoods is next. And so that floats out to be, I don't know, around 45 to 50 properties per year. Again, here we're seeing probably around 40% of those sell during the year. So really nice supply and really strong demand for the neighborhoods.
Do you know anything about, Carol's asking a question. The state of California is giving people $3.4 billion to pay for unpaid rents. Do you know about that?
From what I hear on the news, I don't know of anyone that's gotten that money.
Yeah.
I'm hearing of none of our clients are saying, "Oh, I just got this incredible thing." You know, that's that conversation. That conversation is not coming our way. I mean, maybe it's happening somewhere. It's not happening with any of our client base that's speaking with us about it.
This is a really cool area, Highland Park.
Yeah.
You know, it's funny because as we're going through and looking at these neighborhoods, like I said, when I first got married to my wife, we moved to LA in 1992, and all these places have there's been so much improvement. And I know, John, you're a long time resident of LA, and
it's 95. Yeah.
It's nice to see. I mean, you can debate gentrification versus non-gentrification, and that's a legitimate debate, but it is nice to see these places that, you know, frankly, you're not sure you would want to spend much time in, but now they're really cool. Right. But
at least you're going for dinner. I mean, the restaurant,
it's great.
The restaurant scene in all of these, what used to be far-flung locations is amazing. And Highland Park has been such a success story. It's, of course, east of downtown for those that may not be familiar with it. The story around Highland Park and what's happened there, both on the single family and multifamily side over the last decade, is extraordinary. The appreciation that they've seen. This is an old part of town with Figueroa being the main thoroughfare, and to drive down it today, you would have a hard time recognizing where you are if you haven't been there in a year. So we see properties coming on. You know, we had a nice strong market there in 2019 and then 2020, but we were seeing probably 30% again of all the properties move that are in those marketplaces. So the supply and demand charts are right behind that, and it's just great to see these old neighborhoods coming to life, right? And the amount of renovation and development that's taking place, again, both in the single family and the income property side, are pretty extraordinary.
And are you seeing demand kind of? I mean, are we kind of hitting a softening, if you will, relative to what it was a few months ago, but still strong? I mean, how would you characterize that?
Yeah, I think that what we're seeing is we're seeing pretty consistent. You know, the summer is never a time to make a prediction,
right?
in the real estate. Well, it just isn't, right? I mean, the spring is so heady, and then people tend to get lost a little in the summer, and it quietens down just a little, and all of a sudden, you know, the Chicken Littles are everywhere, and the sky is falling, and it's like, didn't we just have this conversation last July? Right. Every July we have the same conversation, and it's just the market gets a little quieter in the summer now. You know, we can talk about it in October, and I can tell you clearly where we are, but the summer is no indication of anything, you know, other than of where we're going later in the market. Of course, last year, 2020 being the outlier of all of that, because as again, that spring market got pushed to late summer and early fall. So I don't see anything in front of us right now that says that the market in Los Angeles is not going to continue at its current pace until we see a move in interest rates, and everybody's got a crystal ball on that one. All I know is I've been hearing rates are going to move for the last 5 to 7 years, and rates haven't moved more than 0.25%, a half here or there, and then back down over that amount of time. Then there's no question that that's propping up the market on the demand side for this, especially at the intro level. There's no question that's happening. But when those rates move up, my theory is the market's going to slow down. The market's not going to come down. So for all of those guys that are on the sideline saying, oh, well, I'm just going to wait for the market to come down. It's like, well, then the next question is, well, when do you think that might be, right? If you've got a prediction, I'd like to know, because there is nothing on the horizon other than something internationally that's going to change our world. It certainly didn't happen with, the most amazing pandemic we've seen in 100 years. Like everybody thought, oh, well, that's going to take the wind out of everything. And in fact, it took off in a very different way. And there were very few people that I heard that were making the prediction that was going to happen. So I think we're solid for the moment. There's nothing on the horizon. I mean, we're plugged into a lot of economists. We're plugged into Keller on a national basis. Gary Keller actually funds the only real estate research institute at Baylor University. We get all of that information coming out of it. There's nothing there right now that says there's anything unusual going on.
Well, it's interesting, when you talk about interest rates going up, I think we all have this specter of the 1970s where we had two oil shocks. We had an economy that was totally dependent on oil, a manufacturing industrial economy that we don't have that anymore. Okay. And I think we're afraid of no economic growth and high interest rates. But when the Fed is raising interest rates, that means the economy is doing well. Okay. So I think it's when people, they have this knee jerk, like, oh, well, interest rates are going to go up and that's a bad thing for real estate. Well, not if people have more money to pay rents, right? Yeah. I mean, we can talk about that till the cows come home. But we have a question here from Ed. This is slightly off topic, but I want to get your take on this, John, if you've heard this going on. And this relates to fraud. Okay. And what he said is, Ed says, we've seen commercials warning that people's property titles are being stolen out from underneath them and they don't know their title has been transferred until they get an eviction notice. Commercials selling title locks, essentially like a lock on your title. Is this really a concern? We wrote to LA County. To check our title, but got no response. You're not going to get a response from LA County. Your home is already in the trust. Does that protect us from such scams? I think you have to be vigilant. One of the things that you have to do now when you sign a deed, you have to put your thumbprint in the notary book. That's because people were stealing people's deeds in LA County. So it is a thing. John, do you hear about that much? I don't.
I have not heard that. Yeah. I'm on the local board. I'm at the CAR board level.
So you'd be hearing it if it's happening, right?
And yeah, I would hear it. I mean, the fraud that we're hearing is that, last year, $46 million went missing in the state of California as a result of wiring fraud. That's real. That's happening. And so if you're transacting, you've got to be really, really super cautious with what you send electronically, numbers, information, all of that. We're not hearing that conversation, Jim, at all. And what I would say to you, Ed, is have a great relationship with a real estate agent. We're happy to have that conversation. Give us a call. I can get to title. I can research anything it is that you need. You're probably not going to get it directly from the city of Los Angeles, especially now. They're running skeleton crews downtown with COVID. People are working from home. It was not incredibly efficient before. It is far less efficient now. So I think you're going to have a difficult time getting what you need out of the city, but our title guy can pull it for you tomorrow. So if anyone has any concerns about anything like that, or if you want to just double check to make sure that things are recorded the way that you expected them to be recorded, we can absolutely help with that. We invite this conversation. It's a nice service. We're happy to do that for you.
So Charles asks, do you think the moratorium in evictions will impact demand for income properties in Los Angeles? In the city of LA, there's no date in sight for lifting the moratorium. San Diego also has eviction moratorium. City of San
Yes.
Diego does. So are you seeing that show up as affecting transactions?
I think in the beginning, it was a really strong factor in the conversations. And as I mentioned, we lost a couple nice escrows last year when the bottom fell out and people were really afraid of those multifamily deals. And then eventually that settled down a bit and they came back. I can't help but think that there probably are some people that still makes nervous and are wondering, is this the time to get into the multifamily market? I expect it to settle down even further as we come out of this, and that's anyone's guess on what's happening with the Delta variant. We've got a little information coming from other countries, but my guess is by the beginning of next year, those moratoriums will probably be lifted and we'll be back to business as usual in the multifamily market. I think at that point there probably are a few people that are being extremely cautious right now that will step back into that marketplace.
And Jody asks, do you have anything to say about the Beach Cities market for single family homes and nearby Del Air, El Segundo in that area?
Yeah.
Stay or go or hold?
Well, it depends on what your goal is, right? I mean, if you've been sitting on something for a while and you believe it has appreciated nicely, and if you're sitting on something, I can tell you it has, then if your goal is to pull cash out and do something else with that money that makes more sense for you, then absolutely. I mean, take advantage of it. If it's not a hassle for you, if you're leasing it, if you've got nice appreciation, if things are going well for you there, and you're happy in the Del Air market, then hang out, right? I mean, so because you are seeing nice appreciation and there's no reason that that's going to end for you. So I really think it comes down to having a conversation around what's your long-term strategy and goal, right? And where's the bigger win at the end of the day, given where your asset is in the moment and what you could do with that money otherwise and so forth. So and we love those strategy conversations. We have them 5 years in advance. We have clients that call and say, we're going to retire in 5 years. Let's start talking about what we need to do to get ready for that now.
Yeah, actually, I'm glad you mentioned
and that's
that,
awesome.
because I think I will tell you, because I'm in the planning business, I think people don't pay enough attention to these longer term strategies. So if you're going to get if you're going to liquidate a portfolio of 10 properties over 5 years, if that's going to happen and you're going to move out of state and you want a higher cap rate, means capitalization rate. It's almost like the interest you get on a bank account. It's a simple, like if you put 100,000 in a bank and you get $1,000 a year, that's a 1% cap rate. That's what a cap rate is a percentage return on your investment.
Right.
Outside of LA, you will get higher capitalization rates. You will get more interest on your money. You're not going to get the appreciation.
That's it.
So you can't have both. But the challenge with real estate is, you can't sell a door or a window and get money. I mean, you can, but then you won't have a door or a window. But if it's an investment portfolio, you can withdraw some money. The only way you can extract that capital is through debt, which has a cost associated with it. So,
right.
But I would say if you have a portfolio of properties and you're going to exit California, you're going to move back to North Carolina, let's say, you might consider kind of almost like dollar cost averaging, where you might want to sell a couple every year because you don't want to get caught in a dip, right? You don't want to get caught in it where there's a shock to the market and now you're taking excessive risk. So I think planning is good.
And you want to be strategic about it, right? If you do have a portfolio of 10 properties, okay, so let's look at the 10. Here's the spread. These are in neighborhoods where this is happening now. These are in neighborhoods affected by the new train, for instance. Like, where's this going? What's it doing? Okay, well, let's start with these two over here this year. And next spring, let's talk about these. Well, the train's opening in October, so let's push those, to the end of 2022. So there are ways to have, very strategic conversations around the timing of the dispossession of assets, right? And if the goal, and it generally is for most of our clients, maximizing the value of the asset, how do we go about that? Right. And are there capital improvements that could be done that will add incredible value on the sales side? Or does it not really matter? And it's just, it just is what it is, right? And there's a way to evaluate all of those on a very individual basis, right? Looking at that individual property, single family or multifamily, and really thinking about how to create the best possible experience. And what I will say is, the further in advance we have those conversations, the greater the experience for everybody that's involved.
Michelle asks, your advice makes sense for multifamily properties, but if you're considering the sale of your home within the next 2 to 4 years, should you start thinking about selling it sooner? I'm in Encino. Michelle, I would say that if you're in Encino and you've had your property for a long time, my guess is that you have a capital gain far beyond 250,000 or 500. If you're a joint filer, even if it's your separate property, you can exempt 500,000 in gain. Some of my clients will move out of their home and rent the home out for a year or two, and then effectuate a 1031 exchange, a tax deferred exchange into another rental property. You have to leave that a rental for a while. Could you ultimately move into it? Yes, but you've got this 2 to 4 year time horizon. So Michelle, it absolutely probably makes more sense if you know you're going to leave Encino in 2 to 4 years, to start thinking about that now. If you're going to stay in California, you have two inconsistent things. You have your low Prop 13 taxes. I'm assuming if you want to sell in Encino and move to the desert and you want to take your low Prop 13 taxes, you're not going to be able to do that if you convert your home to a rental. So these are some things you really need to think about. And this is why it makes sense to talk to somebody like John and say like, hey, this is what I'm thinking about doing. Talk to me. We put our heads together and we get a strategy together because, Michelle, you're not alone. And John, I know you have a lot of clients who have a tremendous capital gain in their homes. And for whatever reason, it's time to sell. Sometimes those people end up paying a lot of tax is the bottom line.
Yes.
Right.
Well, and the other part of that is that if you're in a home where you've already maximized what your audit will be for capital gains, you're actually not banking the full appreciation that you were getting prior to exceeding capital gains, right? So you're not quite seeing as much appreciation as you would typically see. So, I mean, in a perfect world, every time you got to capital gains, you'd sell your house and you move to the next, right? And you reset the capital gains clock. Now, no one wants to move that much. And if you do, call me. But no one wants to move that much. I don't want to move that much. But in the best of all possible situations, the moment that gain is up, you'd step into the next gain, right? And or the next shelter from the gain. And so, so you really begin to look at less appreciation if you look at it statistically and in that way.
Linda make comments. I represent the LA County Public Administrator. Linda, I'm assuming you're a lawyer. We've had cases with fraudulent deeds filed, particularly when the property is owned by an elder. So it does happen. Ed, it does happen. I think if you're seeing something on a commercial, they want to sell you something. I don't know how that title shield works. You can always reach out to a professional or, I guess I don't think a title company would give a consumer the time of day, probably if you're like, hey, can you get my latest recorded deed, right? But that's something that John does and our firm does routinely is we do reach out to title. And this is important because lawyers can subscribe to a title service, but it's about 3 months behind. And the title companies literally have what's being filed right then, right? Yeah. So they're up to date. So they have more robust research tools than realtors and lawyers do typically.
We can have it for you tomorrow. Yeah. So and with regard to those title shield policies, I can't speak to that in any way. I'm certainly happy to speak with my title rep that I've worked with for the last 17 years and speak with Frank about what the percentage that they see of that and what they hear and when the best way to guard against it. And I'm happy to have that conversation.
But, bear in mind on an eviction proceeding, if you happen to be in that position where your title's been stolen and you have an eviction, you're getting evicted, absolutely get a lawyer.
Yes.
Show up to the hearing, tell the judge, hey, this property was stolen from me. I'm not a tenant. I've owned it. And we do have a fantastic justice system in the United States, and particularly LA County actually has a fantastic justice system. There are a lot of things wrong with California, but it does work. And so, judges do listen and judges do care. So,
and there's no question that elder fraud is real.
Oh my gosh. Yeah.
In so many ways. And so it would not surprise me at all. So we're a caution.
Linda follows up. By the way, when a deed is recorded, the LA County Recorder's Office will send a letter to the property owner to alert them. But when the property that's rented, the notice goes to the property address and the renter receives the notification. Interesting. If the renter is the one committing the fraud by recording a fraudulent deed, the owner is in trouble. In the case which I refer, the tenant pretended to be the owner, sold the property for cash at a discount, then disappeared. Oh my goodness.
Wow.
The owner of the property is now suing. The new owners are arguing that they are bona fide purchasers for value. We believe the new owners may have been complicit, but unable to prove. Oh my goodness. That's
heartbreaking.
You know,
Hmm.
there has to be some remedy for that, where they would communicate with the tax collector's office and send a duplicate to wherever the tax bill goes. I mean, there has to be some easy administrative. Wow, that's really terrible. All right, John, thank you very much
It was my pleasure
for being with us today. And if you'd like to make an appointment with us, you can go ahead to our website and request an appointment. And here's John's contact information, john@barrentinegroup.com, and subscribe to our YouTube page. Don't forget if you're watching this on YouTube. So thank you, John. And thank you
everyone. Jim, we appreciate it.
All right.
Good to be with you all today. Bye-bye.